In today's video, we're going to be looking at 3 things to consider when it comes to bridging finance and interest. Now, there's lots to consider when it comes to bridging anyway, but the interest types are usually what people find the most difficult to understand. So with some use of some really helpful props, hopefully we can clear the mist and make it easier to digest. Follow along and don't forget, if you've got any specific questions about this, always feel free to reach out. So, the first interest type to consider is your retained interest, and we're going to need some props for this. So, imagine this is your gross loan. This is the amount of money that the bridging lender is going to give you on day one. However, with retained interest, and this is the one that most lenders are going to be working with, they actually factor in all of the term's interest and they deduct it at the start of the loan. So this means that you're left with what they call a net loan. Now, a net loan is your gross loan minus things such as your arrangement fee, your interest for the term, and then any admin fees that might be payable as well. The bonus of this is that it's factored in. There's no monthly payments to consider, and what you get is what you get, and you can top up the rest. One other major consideration is that if you pay this loan back early, because they've already factored in this level of interest, you will actually get some of that back by way of a smaller redemption loan. So let's say you've got a 12-month loan depicted here, but you pay it back within 6 months. Well, that then means that you get some of that interest back and you pay back less overall compared to the initial term. This is a really great way of staying in check of your costs and also keeping the costs down at the same time. Your next interest type is serviced. This is your gross loan. Now the difference is with serviced interest, you pay it monthly. So your gross loan will remain pretty much intact, minus a few admin fees and the arrangement fee from the lender. However, each month they'll take away a payment. So it might be your first month you pay, next month you pay, and so on. Now, this might be a bit frustrating because you're paying every month, so you've got to keep that in check as part of the cash flow. However, the bonus of this is that if you've got a very good income or you've got a provable income, alternatively you've bought a property that has tenants in it, they can use this to service that loan. So they are going to factor in affordability checks, but this is a really good way to get more money on day one while still having the ability to pay off the interest each month. Now, there's no interest that's going to be payable back at the end should you pay the loan early. However, it's a great way of maximising the amount of money you get at the start of the project. Now, what about the final type? Well, the third one is rolled interest, so QR loan. Now, with a rolled interest type of bridge, the bonus here is that they factor in the amount of interest at the end. So again, your day one amount is relatively intact. However, you will have the addition of the interest at the end of that loan. Now, this means you are going to have to keep check of things as you work your way through. But the bonus is you're going to be able to factor in significantly more of your money on day one. Now, with rolled interest, most people will see this if they're borrowing for the funds to do the works, or if they've got a very good project with a high GDV, where the lender can afford to factor in that interest at the end. And again, everything is calculated according to what you borrow and for how long you borrow it, but with rolled, everything is calculated at the end rather than at the start. And there you have it. There's your 3 interest types to consider when undertaking a bridging loan. They are retained interest, serviced interest, and the third one, rolled up interest. Now, remember, it's always good to talk through these options with a broker. Lots of lenders do allow you as a client or an applicant to go direct to them, but brokers can demystify a lot of the things that people find uncertain about bridging loans. Now, some of the other things to factor in if you're taking a bridge out for the first time, or if you're just working with new lenders, perhaps it's been some time since you've undertaken one of these loans. You need to factor in things such as your deductions on day one. So the first thing is usually an arrangement fee, which is around 2%. All lenders will charge an arrangement fee. This is like an additional fee or a product fee that you might see on a mortgage. They may have additional admin fees. You've also got to factor in a valuation cost. Now, some lenders will do this on a desktop basis and just charge you for the valuer's time to undertake this. Others will undertake a full Red Book valuation, and it'll be a much thorougher process. They will also estimate current market price based on certain conditions, the end value if you're doing works to it, and also an approximation of what they believe the cost to be to get it to the spec that you need. Now, if you're doing a slightly bigger refurb or even a development, then you might have a QS go out to actually value this on a much more dense scale and then have to report back to the lender. Now, something else that's quite a big thing to factor in are the legal fees, because on a bridging loan you pay two lots of legals. The first is your own representation, and the second is the charge that the lender will have for their own legals. Now, this is usually to protect the funding line that comes from the bridging lender. As we know that with bridging finance, most lenders have multiple streams of money coming into the company that could range from hedge funds, high net worth individuals, high street banks, as well as their own chunk of funds. So the lender's legals cover all of the legal process for the funding line where the money comes from. So lots to consider. But again, make sure that you speak to your broker, or if you want to work with us here at Harvey Bowes, the team will explain the bridging quotes, along with telling you who the bridging lenders are that we're working on and the reasons why we're working with them for your particular deal. So they can talk you through every nuance of the quote so you understand exactly what you're getting yourself in for. If there's a minimum term involved, if additional reports are required, or there's additional considerations that need to be factored in throughout the process of you being on that term. And remember as well, you can talk to the broker about how you want that interest set up, whether it is deducted at the start, paid monthly, or rolled up to the end. Now again, every deal is done on its own merit, and every deal is valued on its own merit as well. So just because you might want rolled interest doesn't mean it's necessarily possible. Just as much as you think you might want retained interest, but you've got better options. So always speak to a good broker that can talk to you about the nuances of bridging finance and explain the whole process to really uncloud all of the uncertainty that can be based around it. So, 3 interest types to consider. Stay tuned for more videos, and if you need any support with bridging finance on your next deal, don't forget to give us a call here at Harvey Bowes. We look forward to seeing you all again very, very soon. Take care.
Looking to purchase a property for investment or development? Look no further. At Harvey Bowes, we pride ourselves in finding ways to make complex and niche deals work. Making sure to explore all the possible strategies and matching the right financing structure to the needs of each investor. Contact Harvey Bowes today. Property finance by investors, for investors.